Let's have a discussion about financing for turnkey single-family residential rental properties. There's essentially two types of financing that's available if you want to buy a property and use debt leverage, which I think is a great thing to use today in today's world in most cases. First and foremost, I talk about long-term investing. As an investor, I'm not a buy and sell guy. I buy, invest in assets that I intend, in most cases, to keep for a number of years. I'll just give you some history. I've still got rental properties in my portfolio that I've had since back in the 80s. Yeah, back in the 80s. So we're looking at 35 years. I've had properties. These are properties that are in good locations, and those locations, the demographics have stayed strong. The product's strong. It has a viability in the marketplace. People want to live in these neighborhoods, these houses. Now, demographics can change sometimes, and that's where you need to move your equity somewhere else. That's a discussion for another time. I'm talking about right now, we're talking about being investors, the long haul, the benefits of being a long-term investor for the cash flow, the amortization of debt, which the tenants pay, the forced value in many cases of buying a property, perhaps at a discount. But the real opportunity is the cash flow that you get from these investments that are well managed in great locations, the cash flow above and beyond the expenses and the debt service you put on the property. Interest rates are historically as low as we'll ever see them in our lifetime right now. So it's kind of the perfect storm situation. Right product, right management team, the right financing, boom, you're good to go. You're good to go. All right, so the two types of financing. There's the conventional, we call government agency, federally government agency subsidized financing, which is Freddie Mac or Fannie Mae. It's 30-year conventional fixed rate financing. There's also the ability to get community banking relationships that will offer also low interest rates in a product or a financing package that's going to be still amortized over 20, 25, maybe 30 years. So the payments can still be low, but there's going to be a provision within typically could be anywhere from 3 to 5 to 7 years on the outset, where that local bank, we call them portfolio lenders, they keep their paper, their notes receivable in-house. They're not going to go long-term 30 years. Well, they can't afford to because it's unpredictable what's going to happen over the years. The only reason we get 30-year fixed rate government agency paper is because the government is subsidizing those long-term rates. A portfolio lender, community bank lender can't go that long. So you're going to get 3, 5, 7 years out, and then they're going to have a call provision where to renew the loan at that bank, you're going to have to go at whatever the current rates are. That's the scary thing. Now, if you're buying a property with the intention of one of two things, keeping it less than, say, 7 years, if that's the call provision note, less than 7 years because you're going to do something else, you're going to sell it, or maybe you've got the capacity to pay down the loan faster. You're going to snowball the loan down. You're just going to take cash flow and just pound that loan down and get paid off in 7 years, or you're going to sell the property. The problem with 7 years out, if you haven't paid down the loan, you have no provision to pay it off, what are things going to look like in 7 years? That's the issue I have with short-term call provision financing. But again, if you're going to dispose of the property or have the ability to pay it off within that 7-year period, and you can do it, I think it's a great way to go. If on the other hand, you don't have provisions or don't want to pay that loan off sooner, you want that long-term financing, and you're going to keep the property typically maybe as long as I've kept some of mine, 15, 20, 25, 30, 35 years. Great products you want to keep a long time. Then you're going to want that long-term fixed rate financing and not have to worry about where the world is in 7 years. So that's the way to look at it. Now, what about the front end of getting these loans? 30-year fixed government agency, Freddie or Fannie Mae paper has a higher cost to get into. There's higher fees, higher cost. You have a relationship with a mortgage broker that gets you through the process. It's still a little bit longer process. It's a little bit more weedy. It's not as consumer friendly as having a banker who actually knows your name. You talk to them on the phone. They're going to be a little bit more streamlined. So 30-year fixed government agency paper, going to take longer, going to be a higher cost to get in. But remember, that higher cost to get in, if you're an investor long-term, is going to be amortized over many, many years. Again, if you're only going to keep the property less than, say, 7 years, then probably that higher cost doesn't make sense. And you need to go with a lower cost of entry, easier to get through the process of financing with a local community banker. That's the way I would look at financing my properties. I hope that helps you understand sometimes the controversy between, do I go this way or this way? That's it in a nutshell. Neither one is right or wrong. It depends upon your intentions with your investing model, your philosophy, and what you want to do with a particular property. Do it with that filter in mind, with that lens in mind, and you'll know exactly what to do. Remember, this is why you're part of Freedom Founders. You're going to get the straight scoop. You're not going to get anybody selling you anything because they get a benefit from selling you a package here or a financing deal here. You're going to get the straight scoop. I look at everything through the lens of the way I would look at it. And that's what you're going to get from me. So that's what you got from me here today. You're always going to get the straight scoop. Remember, you have other people in the group, other advisors who could also weigh in on this situation. I am not the last call on this. Talk to other people. But this is how I would look at those options today if I were you. Hope that helps.